Good evening, everyone, and welcome to another ACY Securities webinar. For those of you who might be new tonight, my name is Alistair Schultz, and I'm the Chief Market Analyst for ACY Securities. Now, tonight, I do have a few things for us to go through in advance before we get right underway. Now, the first thing for us to really look at is that at the moment, if you haven't got an account with ACY Securities or you're thinking about getting a trading account, and this might be your first sort of introduction to trading, then at the moment there is a 15% deposit bonus that is available for all of you to take advantage of, in which case, whatever you deposit into the account will give you a 15% increase to trade with. So you get extra capital for what you're doing. Now, moving on from that, if this is your first webinar, a little bit about me. My name is Alistair Schultz, and as I said before, I'm the Chief Market Analyst for ACY Securities. And so far, I've garnered closer to 16 years of experience trading everywhere from where I made my start on the floors of Wall Street in New York. And since then, I have done a number of other things all the way through investment funds and brokers alike. I'm also a published author for Essentials for Trading Students. I'm currently working on a second edition that brings it a little bit up to date. And of course, I do a lot of coaching in trading, regardless of whether it be CFD stocks, futures, options, or commodities, generally on a one-to-one sort of basis. And I have been featured in quite a few different places. I'm on AusBiz TV quite regularly. I've also been in the AFR, the Sydney Morning Herald, Bloomberg, FX Street, Finance Magnets, you name it. There's quite a few different places I've probably been in that I've forgotten off this list as well. Now, for those of you who might be watching from YouTube, there are a couple of things to note tonight about getting in touch with me whilst we're going through the session. Obviously, I like to give a little bit of a spiel and help you guys out with my sort of thoughts about general market conditions, but there is also obviously a session here where I'm open to let you guys send me your charts and look at what's going on from a technical or fundamental perspective. Now, if you have a question throughout tonight at any time, please feel free to put it through. I will sort of mention, I do prefer it to come through Zoom because that's the one that I am focusing on in terms of the chat function. So if you're uncertain, you can see on this slide here at the top how to chat. Number one, you open up the chat box. The second part is it brings up a chat box, type your question, and in it goes. Now, if you're not sure or you can't find where that little toolbar is, you have 3 different shortcuts depending on what platform you are using. If you're on Windows, it's simply the Alt button and the H key. Obviously, you've also got on Mac, it's CMD, Shift, and H, and then on an iPad or iPhone, it will be Command, Shift, and H. Now, if you are using YouTube, the chat function in there, I tend not to look at because there's just too many things sort of going on to keep an eye on the teaching side of tonight, as well as what might be going on in market. So I do tend to not look at what's going on that front. So please, if you are going to do one, put it as a comment. It makes it just that much easier for me to actually look at what's going on. And I obviously won't be able to reply in the same session, but undoubtedly tomorrow during the day when I'm there and I see the comments, I will naturally reply as quickly as I can. Now, in tonight's agenda, there are a few things to sort of get through. I am intending for us to have a bit of a talk about inflation. Now, I know inflation has been something that's come up on the charts for, or at least in the media for the last couple of days, particularly with all the moves around bond markets at the moment. So I thought it was probably necessary to have a little bit of discussion around what actually goes on in bond markets and how we control inflation. Of course, what the relevance between bonds, inflation, and stocks are. And then from there, we might have a bit of a look at oil and OPEC because we do have an OPEC meeting coming up this Friday. And in addition to that, I thought we might talk about gold because we're seeing a little bit of a confluence between gold and inflation. There's always been one related to interest rates. And of course, we're seeing prices on gold sort of go down now. But interestingly enough, we're getting lots of mining happening. So I want to have a bit of talk about that as well. Now, if you have charts or questions, it might interrupt or change how I go through some of these tonight, but because there is some pretty heavy content stuff. So don't worry so much about that. If we do sort of start to run out of time or I don't get through all of them tonight, I'm quite happy to go over them on Thursday anyway and make it a bit of a double Dutch session. So of course I would love to look at your charts over just my own. So to get things really kicked off, we might get started underway with what's going on now. Before we do get right into it, the last thing we have to look at is a risk disclosure warning. And this warning basically says that anything that I do sort of advise on or talk about tonight is to be considered as general advice and not personal. Obviously, I don't know your own financial situation, so I can't provide, adequate sort of personalized advice for each of you. Now, in addition to all of that, I always like to sort of add the spiel that when it comes to trading, regardless of what asset class you are trading, there is a certain level of knowledge that's required to do it. Obviously, if you don't have an idea on what your current trading experiences are, or what your current risk tolerances and risk levels might be, and of course, what the objectives of your trades are, then perhaps it might be an idea to seek out some additional help. I'm quite happy I'll give my email address at the very end of tonight, or at least my social media contact thing. So if you do feel like you need a bit of a hand, then please feel free to reach out and I'll try and put you in contact with someone who might be better suited to helping you. Of course, I will always do my utmost to try and help you guys as much as possible. Now, to just get things underway, I am just going to throw a chart in front of us here so that we can sort of have a bit of a talk about it. I'm also going to bring up a couple of other little things for us to consider at the very intermediate moment. Now, the first thing is I always like to, before I ever sit down and trade, I always like to have a look at what's going on in the economic calendar. So first, we're going to start off with this. And this calendar here is freely available from forexfactory.com. There are a number of different economic calendars that are available. So don't stress if you're not sure which one to use. I tend to like using the Forex Factory one for FX pairs, predominantly because the information you get is all related to the FX side of the market. Now, obviously, there's a lot of different ones. Now, if you're dealing with stocks and futures, you're probably going to want to be paying more attention to earnings season reports and similar things like that. If you're dealing with metals, then you probably want, and gold and silver, all those sort of things, then you're probably going to want to have a look at metals daily. There's quite a few different places you can get them. No one place is right or wrong. I just tend to find that it's how it looks to you. If you can look at this easily and work out what you like, then it makes it all that much easier, and you just put it as a part of your routine. So tonight, when we look at what's going on, and even throughout today, we should really sort of have a bit of discussion about that. Now, we've seen a few different things go on throughout today. Most of it has been low impact events indicated by the yellow marker. But of course, we have heard from the Reserve Bank of Australia today. They decided to leave rates left unchanged. But we also have heard from them earlier in the week where they expanded their asset purchase program. They basically doubled how many bonds they were buying, which is why we're going to have a bit of a discussion about it tonight. Outside of that, we have the German unemployment change. We've just seen the Spanish unemployment figures come out, which have not been all that great. We've seen an increase in the number of people looking for work. And of course, we've also got some of the other sort of little things in here, like German retail sales and the Japanese 10-year bond auctions, and which are probably getting a little bit more in the way of being attention paid to them at the moment. Now, outside of that, in the later session, there's not the ones that I always look for. I always like looking at the global dairy trade index that comes from New Zealand, and that's because New Zealand, one of New Zealand's biggest exports happens to be dairy products. So, the value of whatever the dairy product is they're exporting on that day and age, usually is powdered milk substitutes, actually does impact on their GDP and their ability to generate an income. But with the COVID scenario around the world and exports and imports being somewhat restricted, their numbers have a pretty low baseline at the moment. So little things make a big difference in this instance. So we've all got a bit of an idea now on what we're looking for tonight. The ones to really pay attention to. German unemployment is important. Don't get me wrong. But when we've got so much focus on what's going on with inflation, bond yields, stimulus packages, and all those sort of things affecting our currency pairs at the moment, looking at what's going on with our CPI figures are actually very important. It means consumer price. It's a consumer price index. And really, when we look at inflation, there's a lot to sort of unpack. I think there's about 87, maybe 90 different indicators or measures that we sort of throw in a basket together and go, well, this is what inflation is as a single figure. But the reality is it's not that simple. You have so many different areas of the market or the economy that we have to really look at and focus on. So if we are seeing, for example, just to put it in simple terms, if we're seeing inflation tick up on goods and services, but only in one category, and that might be healthcare, for example, and you've got an increase in the food side of things, but then on the free range of movies and all those sort of things, those retail values remain subdued, then you've got uneven inflation occurring. And inflation is never even. It will go up where it needs to go up, and it'll go down where it needs to go down. Now, what are we going to be talking about specifically on inflation? Well, I thought that we would start off with a few different things. So I'll just move this away. And I have been really, really thinking about, and I've spoken about it a few times today whilst I was on Ausbiz this morning, and a number of other things, but I think it's probably important to understand what inflation actually is. Inflation is basically just a term, and we've all heard about it in the news recently, but it's a substantial element to consider, particularly over the next few years to the next few months. In a nutshell, you can explain it through a process. So if we think about charts, regardless of whether it is the Aussie dollar, the pound dollar, whatever, it can be anything that you like. It's basically about the idea of a currency losing value. So it's losing value against the prices of goods and services, which are on the increase. So if the cost of services and goods go up, but the value of your currency is going down, then it's going to impact your cost of living. And that ultimately leads to a slowdown in growth. So the generally accepted sort of definition varies a little bit, but when money supply exceeds your economic growth, you have inflation. And it's a crucial component for so many people to be measuring, that. But central bankers really pay a lot of attention to it. Us as bonds, stocks, futures, commodities, CFDs, traders, all need to keep an eye on that. And whilst it is a very crude measurement when it comes down to a single represented number of estimated value, it causes a problem. And so when we talk about inflation, you quite often hear the words purchasing power of parity. So I am just going to try and there's a chart that I can bring up that I'm just bringing up on Google now. This gives us a bit of an idea about what we mean by inflation and the purchasing power of things. Now, I think the best place I've seen it is probably on The Economist, if they have the picture. No, they don't have the picture on that one. I'm just trying to make it real simple for us to look at. So I'm here we go. This will work. So when we think about Bergonomics, this is, yes, it is a very crude sounding word, but I promise you it does have some very meaning to it. Now, go away. Okay, thank you. Now, when we look at Bergonomics, this is the idea of it, right? So here we're dealing with the price of a Big Mac burger from McDonald's. That's why we call it Bergonomics. And the idea is that all the components that go into making a burger are the same. No matter what country you go to, the price of lettuce and meat will all remain the same. But the cost of the output of all of those products is variable depending on how valuable your currency is. So we can see that in Switzerland, it is the most expensive because of where the location is. Now, the same sort of effect we can use, instead of using burgers, we can use TVs or laptops or a variety of different things. Now, if we're thinking about it from a laptop perspective, a laptop in Japan or a laptop in Hong Kong might cost 4,000 Hong Kong dollars, whilst in the US, that same laptop is only $1,500. Did the value of that laptop change between each country? No, it didn't. It's still got the exact same components. The build price is still the same. The only difference is the power of the currency. Which one has more value to it because of whatever reason might be influencing it. So that's kind of where we sort of sit right now. But instead of it being about a burger or being about a laptop, it's about the broader range economy. It includes pretty much everything, right? And so when we think about this idea of inflation, when prices rise but the value of the dollar falls, it doesn't necessarily mean it's a bad thing. It just means it's respective and carrying on to the idea. Now, how do we actually control inflation really comes into the next part of this sort of summary. In order to combat the slowdown in growth, central banks really try to manage the total money supply. And you would have seen I'm just bringing up another chart again, you would have seen potentially, things about M2 money supply, which if you have looked at your economic calendars before, then you will have found it quite regularly. And now this M2 money supply thing, we do get them from the Fed, we get them from all the central banks, and effectively it gives us an idea of how much of the liquidity is available to the market. And it will come out as a number. You can get them directly from here, but I've also seen them, they always come up on here as well in your economic calendars, and they'll just give a number. And they'll show you, in this instance, how much the money supply is increasing. The higher this chart tracks, the less valuable the currency is. So if we think of this, we're looking at the M2 money supply for the Federal Reserve. So this is for the US dollar. As the value of the billion or the billions of dollars in circulation goes up, so you can see on the left-hand side, billions of dollars, and the time on the right, by this stage, it keeps on going up and up and up and up, and they keep on adding to it. Now, the further this goes up, the dollar that might have been worth $1 down here, all of a sudden it's now, 16 times higher in the amount of total available products. And we do the same thing with stocks, right? If we look at a stock and we all of a sudden we go, okay, well, the company behind that stock is deciding to do a split, then all of a sudden we have twice as many stocks available than there was before. And so your stock, if it was worth $1 before, is now worth 50 cents. So the same thing actually happens to currency every single day. And whilst we are trying to combat and control inflation, it's generally done, through managing this money supply figure. We're trying to influence it, and that's exactly what stimulus does. It's done to try and keep those inflation numbers within tolerable limits. Now, if we were to look at pretty much any of the central banks, I think most of them have a inflation target of around 2%. And that will give us, the FOMC is 2%, but they're also wanting to run a little bit hot. Australia's inflation target is between 2 and 3%. If we keep on going through these and find 2% for the Bank of England, so they've all got this target of around 2%. Now, if we were to go back and look at inflation in the 70s, it's a very, very different scenario. So, this causes a little bit of a interesting dynamic for us to be in now, because we don't have high interest rates, we don't have high inflation, and we're starting to see economies starting to re-emerge from what's happened with the pandemic. We've got good control over COVID-19 starting to roll out. Vaccines are starting to happen more effectively. We've got less numbers in hospitals. I think that we've seen so far that we've got like 80% less people from COVID-19 in hospital now. And these stimulus checks are still continuing to get posted out. So inflation undoubtedly has become a very high and popular topic of choice. Now, how do we look at this from a bond point of view? Now, I'm just going to bring up another chart. I know you guys are going to hate me by the end of the night with the amount of charts I'm showing you this evening. Now, this one here, you guys have probably seen this before. This is Darkube. It's one of the places that I use for sort of free information. But one of the things it does do is it gives us a little bit about bond markets. And naturally, I enjoy bonds probably a little bit more than most people. I'm just trying to make that bigger so we can see a little bit more of it here going on. Now, when we look at sort of bond markets, they're all in the green today. And that suggests that they are starting to improve. Now, naturally, we want bond markets to be above 0%. But you can see German government bonds, or German bonds as they're called, minus 0.56%. French government bonds, minus 0.32%. The Italian ones, 0.51%. So they're only just above 1. And there's always a lot of speculation on the Italian government bond and the German bonds. Now, we always tend to focus on the 10-year yields. And this is because it's the one that's probably the least controllable of the lot. It's the one that you find is a little bit harder to sort of deal with from a central banking perspective. Now, while the headline we're really looking at is that inflation versus stock, what's the deal with it? It's really important to understand the relationship between inflation and bond yields. It's not a very kind or loving relationship. It's actually very inverse. It's like a divorced couple. Inflation is effectively the Bond villain to 007. They counteract one another. As inflation starts to rise, the purchasing power of bonds and the future returns that we might get from them start to degrade. So this means bond investors, each time they start to see this inflation level start to pop up, they go chasing higher and higher bond yields to try and accommodate for the rising inflation risk that's going on. When we take a step back and consider the rising yields in the global 10-year bonds that we're seeing right here on the screen here, there, then we end up with I've predominantly been looking at the Australian and US 10 years because they're the two sort of benchmarks that I tend to focus on. But from the last week, it shows that investors are more in demand of yield in line with a rise in inflation expectations. Obviously, the RBA has stepped in. That's what happened yesterday. And they doubled their monthly purchases to $4 billion, which originally, $2 billion a month. Now it's $4 billion a month. And that immediately slumped the 10-year Aussie bond yield very, very quickly. Now, while rising yields and inflation can be a good thing, it's only when inflation can be controlled and it's gradual. If we see rapid increases and spikes like we saw last week, it really doesn't allow the other areas of the economy to absorb those changes. The higher inflation goes, the higher yields go, the higher interest rates go, the bigger the borrowing cost. And when we've seen so much borrowing happening over the last year, you can understand why people get a little bit jittery over the idea of where inflation is sitting now, where bond yields are sitting now, and everything else that comes with it. Usually, the first noticeable symptom to someone who might not understand bonds or inflation and how it works is that they see a rapid increase in borrowing costs at their local bank. Now, provided inflation remains gradual and it's accompanied by yields growing at similar growth trajectories, it's not so much of a problem. But volatility in bonds is something to be feared. If yields suddenly rise, forcing repositioning of people's portfolios, people are moving their money from stocks and commodities and ETFs all the way over to here to in bonds, then we are probably sitting in a scenario where it becomes a very difficult shift to deal with, and it will likely harm stock prices. The simple explanation as to why is that if a unit of measurement, being money in this instance, suddenly shifts its value, then the valuation of a stock becomes incredibly difficult. The time value of money that's related to a valuation method such as discounted cash flow and perhaps earning at profit P to E sort of ratios as well means that it requires the bond yields percentage as a discount rate. If the yield rises, then the higher that discount rate input and the lower the actual present value of that stock. If we use an alternative valuation technique such as price to earnings, it still results in that same discount rate affecting the valuations inversely to the rise in the yield. The higher that PE ratio is, the more sensitive the yield changes to a stock will be, and this is due to present values being derived from expected earnings and not actual results. So some of you, I'm sure, are probably wondering what a price to earnings. So here's Tesla. It should load up here. And when we look at Tesla and we think about what happens in the market and how we do some valuations on it, the PE ratio is this number. And that is an extreme PE ratio, I might add. This basically says the amount of things that they sell to how much revenue they actually bring in. And when this is times, in this instance, 1,114, you can estimate that what they're actually selling versus what they're earning is very, very different in value. And you get the same effect happening when we look at what goes on in other markets. Generally speaking, a 20 times PE ratio once upon a time was considered pretty high. Now, when we're seeing things like that, it's probably much more concerning. So I'm not, whilst this is one way of doing it, looking at your price to earnings, your price to book values and all those sort of things, they're all the same. They're all the technique of valuing what's actually going on in a particular stock, or in this instance, we're going to be looking at an economy. So with those different discount rates affecting the valuations, you end up in a situation where things like this, like Tesla, will be seriously affected by spikes in bond yields. And you will see them being the ones that are most sensitive to those changes in rapid increases in borrowing costs. Now, what do we need to know, and how do we think about this in terms of a portfolio, and how do we think about this from a CFD's perspective? I think the need to track inflation has become a much needed focus. Prior to this, we could pretty much guarantee where inflation was going to be moving to over the last years, and it tends to take a backseat once you've got a stable economy. Now, particularly those with high exposure to the tech sector and where we see some of these crazy high PE ratios, we're going to see problems. But with low wages, low rents, $4 billion per month in bond purchases, and what we've seen from the Reserve Bank of Australia effectively setting a floor for us to work off, it becomes positive. It's still a very slight or moderate positive, but it's still positive. In my book, for Australia, while inflation does carry some level of concern, there's little risk of sort of persistent rapid climbs in inflationary figures. And I'm not certain we can fully discount the idea of spikes in inflation from occurring. But what I can look at is that right now and over the last year, our baseline figures, so where we call zero, have been sitting so low for so long that it's undoubtedly going to cause spikes to some degree, particularly over the next year. So these are things that need to be put into consideration when we are thinking about our trading. When might we find a bond yield that causes a spike on the Australian dollar? And when might that be a overall problem for us in the longer term? Now, in today's trading and where we're looking at going next, I'm hoping that that sort of little summary has helped a little bit. Now, to move on to the next bits, we've got a little bit to sort of think about when it comes to oil and OPEC. And I'm going to bring up some charts on oil right now when I can find, there it is, WS is right in front of me. Now, looking at WTI, we have done quite a few markups of this. I always like when we're looking at charts that, perhaps you guys haven't looked at in a while. I look at oil quite regularly, but in case you haven't, we'll mark up a couple of lines here on the chart whilst I'm talking through what we're sort of seeing. Now, when we think about oil, we know that it's really a supply and demand based commodity. And for years and years and years, we've been able to go with the idea of increase in supply means less demand, and that means lower value. Now we also have to contend with regulation that's starting to come in, but it's still not quite at those extreme levels yet for us. Now, when we think about oil this week, we have got on the 5th of March, OPEC meeting. Now, I have spoken about this OPEC meeting before, and I have given a few little views on it, but the closer and closer we get to this meeting, the more we're seeing prices sort of devalue a little bit. Now, whilst we've got this lovely uptrend that's sort of been going for some time now, we still have these significant points of interest. There's one here, one here, one here, and we could even put one just here as well, sort of in the guts of price. So if you think of these as your points of, and even where current price is sitting there, we can think of these as sort of our barriers. They're not permanent. They're not ones that are going to stay forever, but these are sort of areas we can sort of think about and go, okay, if price is on one side of this, we can use this as a support line, or we can use it as a resistance line. Now, I think we can pretty much say, we can't anticipate them not wanting to cut, to not want to cut further on the amount of supply. But I think it's pretty safe to say that they are likely going to want to increase the total number of production when it comes to the OPEC group. Now, if we were to think about this from a little bit of a longer term perspective, the last year they've been dealing with really stringent cuts. They have had to be trading in very small quantities to try and ensure they don't get another price collapse like we saw back over here in April 2020. Now, whilst on this chart we get to a maximum low of about $3, that's because in CFDs we move to the most forward futures contract available. The futures contract that expired, however, in March and April would have seen saw close to minus $37 per barrel. Meaning for every barrel that, if you owned a contract of futures, for every barrel that you wanted to sell, you'd also have to give the guy $37 as well. So, at that point, the barrel itself isn't even worth the money that the oil's in. So in this instance, now we've gotten price up to the 60 sort of, we've seen a high of the $63 range. We've seen lows of 59. On Brent, it is very much the same when we look at it, which is UK oil. And we're seeing sort of 63 now. It always sits a fraction higher, so it's hit a max of $67 per barrel. Now, I tend to trade US WTI, and part of the reason that we've seen prices continue, if you would remember this time last week, or the week before here, just where I've got my crosshair now, in this area, we were dealing with a bit of a freeze over in the US. So we had the US in a absolutely fridge-like state, and it was not enabling them to actually make production. So naturally, we can't produce oil. So therefore, because we can't produce oil, everyone sort of panics and goes, oh, how are we going to get oil? And the value of oil started to rise. Now, this week, we're dealing with, what about OPEC? And OPEC's been on my mind for a good solid month coming into this. Now, like I said before, I think the chances of them increasing output are very high. In fact, I would bet most things on it. But the big question really comes, and it's probably it is an obvious decision, and it's an obvious number to sort of say, but the big question is, how much are they going to increase it by? And think of it from this: too little of an increase, we're going to see a spike in oil prices. So if the market, and we price in the idea that we think, well, they might increase supply by 1 million barrels per day for each country, then in that, or sorry, 500, let's start with 500,000. They might go, we might increase it by 500,000 barrels per day. If we sort of go, well, that's not really enough, don't you think? I mean, if we're only getting an extra 500,000 barrels per day, and we've already got still more in supply, and the US is going to start rebooting up production soon, then where are we going to go? And the value of the price goes up, or the value of oil goes up. The other side is too much of an increase. If we have too much of an increase, it's an inverted decision. It ends up pushing price down, and we get a bit of a spike. Now, they've got a very, very big decision to make, and it's going to have to try and balance it. So whilst they're trying to do that, I believe the meeting is on Thursday, could potentially be Friday. It just depends on time zone for you guys. I'd recommend, depending on what time zone you're in, jumping on your economic calendars and having a bit of a look for that one. But when it comes to where things might go from here, I mean, I'm firmly under the belief that they are going to increase production. I don't see them being able to do it light. You can see here, we've got a nice head and shoulders pattern. So we're starting to get people wanting to price this stuff in already. We're trying to estimate where the value of oil is going to go to next, because we're banking on the idea that either outputs are going to increase, or and it's not going to be either enough, or it's going to be too much. So we've kind of got two sides to sit on. Where do we sit on that? I'm going to leave up to you guys. Personally, for me, I think that we are going to see an increase. I think they're going to be sitting just under where it really needs to be, and that we will likely see a spike in price, moving oil figures up a little bit further again. Now, the other one to consider here when it comes to OPEC is actually the relationship between Russia and Saudi Arabia. And this has always been a bit of a patchy relationship on the whole. But the big real, I suppose the stalemate or the third wheel in this scenario is actually what we see coming out of America. Now, Russia doesn't like America making oil. They've never hit it. It's one of those factors of life, and it is very much a dynamic that we need to incorporate into looking at oil on a regular basis. Now, anytime oil gets to this sort of price level, between sort of, say, $58 and $65, the US tends to start making a lot of shale oil. And that's because that's the point where they actually turn a profit when they export it. They'll make it for themselves and be self-sufficient, but it's when they start exporting it that really becomes the big problem for Russia, because all of a sudden, we had all this share of the market, and we've got a sweet grade oil coming out of the US, which is arguably, yes, it's more expensive to buy, but it is better quality. So if they lose that part of the market, then that's less income in their pocket. And I am very, very curious to see what happens around this at OPEC meeting, because naturally last time this happened, we had the price collapse, minus $37 a barrel in futures markets, roughly down to like $3 in CFD markets. And that was the big one to sort of really worry about. when it comes to that side of your trajectories and where you think about price going. The whole reason for it last time was, in fact, because OPEC Saudi Arabia wanted to increase the price per barrel, and Russia didn't. They didn't want them to increase the value per barrel because it would mean that the US would get involved. So even if we were to go back to this, we'll put it on a daily, make it easy. If we go back to a daily before sort of pandemic, this was at about this point here in the middle of February that they were debating this. I think they wanted it up, sort of mid 60s is where we're going. So this range here we're in now is kind of like the danger zone for them. And you can see even where our price points are, right along $49 to sort of $66 is where we have to really think about where do we go, where do they go next, and how are they going to deal with it. So that relationship between them is probably the hardest part to take a punt on. We can't guesstimate on where they're going to end up going next, and that is problematic over the long term. Now, in terms of charting this up from a technical perspective, it is pretty simple to sort of put up and do. In this instance, we've got a very, very long-term uptrend that we can sort of hang out with going up sort of this way. I don't mind putting it like that. Yes, I know that we have a little bit of a breakout here. We have 1, 2, and now our third point of contact. So this does give me a little bit more promise that I think they are going to put increased production, but they're going to underdo it. So, this is a nice place for a bounce opportunity, a stop loss behind here. The idea being that you would have run a stop back on this side, and then you'd be shooting up for this direction here. And realistically, my target, I'd be aiming just to go for $63. If I can get to $63 per barrel from, down here at $60 a barrel, that's a pretty tidy profit. But of course, you could always hold on to that position and keep on going with the long idea behind it. So, this is really not a bad opportunity to go in. If you were concerned about where this sits, then run it with a secondary stop behind it. So run this as a, your main, you call this your break-even point, call this your secondary, and then make this your disaster stop down here. In which case, even if you get to this point here, you still, it's not going to be horrible, provided you make sure and manage your sort of leverage and your position sizing. Obviously, the bigger the position, the more damage it's going to do. But if it does start going up and it starts rallying beyond this sort of pattern going on, then I would be quite happy to continue loading up on my positions. Now, bringing us down on the time frame for that, obviously, I know you guys tend to be a little bit more intraday than what perhaps I am. And there's still more patterns appearing here. We've got a double top sort of thing starting to change. It's not perfect. It's not exactly what I would like. And even this is indicative of that. So on the hourly chart, we've got, a low here, our next low happening there. If price was to come to about this point here, close above that line at the $60.31 mark, I would consider entering a long position as well, other than, the longer play. This would just be for a short one, trying to find a few bucks, maybe at most, maybe even 50 cents to sort of play with that. Now, on our 5 or 15 minute, you can see here, there's a pretty well good picture of it. It hasn't ended up sort of going with the full distance at this stage, but it also hasn't broken the previous. So until we see a break at this level down here, the 59.71 cent mark, then we can sort of guess that this is likely to still continue going this direction. You can see just how much it's pushing back and forth. We're getting red, green, red, green, red, green. So there is a bit of a battle going on right now. And I'd be quite interested and focused in keeping an eye on where this goes. Now, on this sort of trajectory, it is in a short side, but overall long-term trend always wins on your direction. This is clearly uptrend. There's no denying that. So looking at what we see on this chart means that we are probably, we're still trading with the long-term trend, which is the important part to consider. Now, if anyone has any questions, let me know now before I move on to gold. I'm not going to spend too much time on gold because there's a bit of a picture I want to show you, and then a little bit of a look on the gold side of the market in general, just in XAU USD. But to give you an idea of how the relationship between what we're talking about on inflation and bonds actually relates to a gold chart. So if you've got one, throw it in and I'll try and answer it quickly, or perhaps I'll have to leave gold for another time. But otherwise, we will move into the gold section for tonight. Now, the image that I'm bringing up now is giving us an inverted view. So I'm hoping you can all see this quite clearly. The yellow line is gold to the US dollar value. Yeah, so pretty much it's XAU USD in a nutshell. And the black line is our 10-year government bonds, less inflation. Now, whilst, where you're saying, wait, hold up, Alistair, the chart you've got here is on the downside, whilst up here is going up. And so gold is sitting in the right direction, but what we're actually seeing is a reverse. We've got one of these inverted, and it just gives an idea of how correlated 10-year government bonds, less the inflationary measure, and gold are actually tied together. And so I would fully anticipate that the further we see bonds continuing to go up, we're likely going to continue to see the pattern of gold run down. Now, this is something to sort of think about. Whenever we have a period of inflation, people have traditionally tried to use gold as a bit of an inflation. But when we were doing that, it was 1970. We were seeing constant declines in the value of yields in bonds, and of course, inflation was kind of skyrocketing. Since then, it's just been constant downward trend for interest rates. So we've been turning towards fixed income, and we've been trying to protect ourselves with gold. On the inverse of that relationship, so we were going down during the 70s and after, and now and has been up until pretty much this point, even all the way through the 90s and then into the 2000s and then the 2010s. We've seen rates just continually fall down this way. And so it's become one of those things that gold sort of goes against that. Now that we're seeing the opposite, the chances are we are going to see a lot of people trying to move their cash or their gold, I suppose, in this instance, where they're keeping their money, into other areas where they will get a dividend or they will get a yield of return from a bond. So that's something to important to consider. Now, I have also done, recently I did a video for YouTube on where I went to a gold vault and actually specified and spoke to a couple of guys there dealing with on a physical level. I would recommend, if you're not sure about some of those measures, that it's not a bad video to have a watch. Of course, I'm going to say that because I've kind of made it, but it's probably, I do try and do those sort of things from an educational value point. Now, again, here, little pop out, that's okay. It's back in, it stays there. I'm okay with that. The one that I do like to do is this. We have a very, very nice setup. We've got 3 points of contact on the bottom. We've got 3 or 4 on the top, even with that minor, deflection there. So in this instance, we wrap that up on the top side to give us a bit of an expanded view for it. And right now, my play for gold has been short for a couple of months now. And realistically, I think it's likely to continue on that pace for some time to come. And this is just looking at the daily chart, of course, don't forget. Now, moving us down onto the 4-hourly, we do have, still that same trend. These are very, very hard and fast. There's a head and shoulders pattern too for you to have a look at. So I'm just going to put a bit of a shape around that to make it a bit, highlight in case you missed my mouse cursor. And over here, we're starting to get, this has been a pretty a resistance sort of a pattern that has started to play out and ended up working out in this first instance, and then it's come back for another go anyway. Now, right now, there's nothing that really stands out to me that says, let's take a trade right this very moment. But I am certainly holding on to short positions on gold, and they have been paying off quite well for me. There's another head and shoulders pattern that's right there. So we're getting them on multiple time frames at the moment. And these sort of things are good to look at if you can identify them. That's not really one. I don't like that one. I'll leave that one alone because I don't want to teach you guys the wrong sort of thing. And they do play out. So if you do see these sort of patterns, let them just roll out. Technical patterns are working really, really well on on gold positions at the moment. I've certainly found quite a few of them just in the few minutes we've been sitting here, but also during my general day-to-day in trading. If I do come across any sort of resistance patterns, I will take a trade on them just to test out the theory. Right now, it's a little bit haphazard. But ultimately, if you've got a trend line going up like so, then an opportunity to re-enter into the long-term downtrend that we've been seeing for the last couple of months will be to wait until price crosses this trend line. If price crosses this trend line, and this is now on a 15-minute chart, so this is more applicable to us. If we do start seeing this go up, go up, go up, and it's retracing, once this crosses below, I will be looking for a short position or taking a short position once price closes below that trend line. Now, that's a very simple way to re-enter yourself back into the same direction. Now, of course, I will always give you, we've got these sort of lines. The only thing I dislike about this whole sort of jig and going for the short is we're going for that much. We're going for about $130, $150 change per ounce in value. So we're at the bottom end. We have all of this support and resistance as well to contend with. So, top side, bottom side as well on this. And we're right in the middle of that zone. So I'm not at all, I wouldn't at all be surprised if we see a repeat of this happening right here for a bit, just whilst we see where bond markets are going, where people are recalibrating with their positions and portfolios, and of course, where we end up seeing inflation roll to as well. So all of those are, sort of sitting in the midst on that. But if we keep them on the short time frames, then, it does give you plenty of opportunity to sort of continue trading on that trend side. In this case, you're not looking for big moves, but you will be still able to find that you turn a pretty good profit out of it. Now, 5-minute chart, again, it does look quite, we're already starting to see like we've had one position that could have been an opportunity to enter. You would have had a bit of a stop. My recommendation would be your stop loss sits across there. You want a little bit of breathing room just in case you get a bit of a wick happening, and then looking for a short position to happen when it closes below here. If it goes above this point, the 1,728, call it $30 per ounce, then I would be wanting to sit and wait and just have a bit of a look again and rethink about my positions. That would be my general suggestion for the gold side of things tonight. Now, that's real. I've run out of time and gone over time. I know, I'm sorry. I do apologize for that. I have a habit of it. And I obviously don't want you guys to miss out on dinner or get the break that you need after work. So, I will try and tidy this up and keep it closer to the timeframes required. Now, just to give you guys, that last bit of help, if you do want to get in contact with me about anything from tonight, feel free to send me a message at any of the available places on top. Of course, if you're on YouTube, you can just drop it straight in the comment section now. Not in the chat function, remember, but in the comment section. It can be anything. If you guys have found that there's a few things that you've not quite picked up on, or you need some time to consider your questions, then please feel free to send me a message via any of these places. Probably the best one to catch me on is Twitter, which is the top left one to look at, and of course on the YouTube channel. And I will always try and formulate a response for you in a fairly timely manner. Otherwise, I will leave you all to it for tonight. And I do look forward to seeing you all again. The next webinar will be on Thursday at 7 p.m. Australian Eastern Standard Time, just like today. And until then, I will leave you all to have a wonderful evening. And I look forward till next Thursday to see you all again. Bye for now.